Guys, I was looking at some more charts over the weekend, believe it or not, and here's what I have discovered. I hope you will find this information useful. So, the last video I posted, I precisely, completely got it wrong on the market crash on October 19th, but look, honestly, I just could not resist it. The October crash in 1987 happened on October 19th, so I just really wanted to take that opportunity and see if the history was going to repeat itself. The charts were clearly pointing to a downward spiral in the markets. However, even though it did not happen on Friday, October 19th, I still do believe, based on some more information that I have discovered, I actually have received some more confirmations that indeed we're heading for a big market move lower. So here's what these charts are telling us. They're pointing to a deflation. And so if maybe you're not 100% familiar with this term, I'm just going to break it down in just a few simple words. Deflation is basically a period when the economy is going through a slowing growth and slowing inflation. And I know this is probably a bit confusing because if you are following the general media, all they want you to hear is higher interest rates. Generally, higher interest rates would be indication of higher inflation. What the charts are telling us and the type of action that investors are actually taking is pointing down to slowing inflation, not an increase in inflation. And so when we have the two factors, when we have slowing growth and slowing inflation, that actually equates to deflation. So keep that in mind as we're going for the review of some of these charts. Now, so far, the only argument I think we could have brought against this was oil prices have been booming, that have been going steadily higher. However, last few days we've had consecutive drops in oil prices. Now, oil prices on the rise is typically an indication of higher inflation. However, with the chart of oil looking the way it currently does after Friday, October 19th, that sort of clarifies my last concern about whether my deflationary fears are correct or not. So the oil has dropped and actually has created what I call, in many cases, a bearish type reversal candle. As you can see, every time we see this sort of candle being created, shortly after that we get a major move lower in the price. As you can see, another one right here, and we get a major move lower in the price. So now we got another one. So I think the next leg down, as many analysts are saying that oil is going to rebound from here, that this may be actually an attractive level to be long oil. We believe that actually oil could drop further from here, indicating that we're not heading into a period of inflation, but rather exactly the opposite. So since the markets actually did not crash on October 19th, let's take a closer look to identify what actually did happen. We were not necessarily calling for the crash. We were calling for the crash to begin, and I think this is precisely what happened. Take a look and decide for yourself. So markets in the US, because of markets bouncing overseas, we actually had a significant reversal. Some markets were dropping to the extent of 500-600 points in Asia, and they were bouncing in reversal and finishing in positive territory. Now, in response, this is a picture of S&P 500 intraday, 1 day, 1 minute chart on a Friday. So this is the action that we actually did get in the United States. So initially the markets did go higher. I think it's very important to point out that they did go higher on lower volume, which essentially within just an hour of failing to break above the level of 2,800 in the S&P futures after trying to take that level out 1, 2, 3, 4, 5 times, okay, the markets started heading lower. Now, I know what you're thinking. Well, they didn't really drop like you thought they were going to drop. Again, this to me certainly looks like the market could be heading lower. Not just the fact that this short time frame chart looks bearish, Okay, as a matter of fact, in our 13 markets move formula, we identified this type of action. We call it a market move number 2, which even though it looks like everything is going higher and everything looks positive in the morning, when the market reversal takes place, that actually indicates that the market is completely out of energy to run higher. And generally speaking, in this type of moves, what you want to do is you actually want to short the bounce. And actually, if you were a subscriber, that is exactly what we were doing in our VIP alerts. That is exactly what we're taking advantage of. And so the importance of this, the fact that market actually had a chance to bounce Friday on what appeared to be better than expected news in China. And let me break down better than expected. Sometimes individual investors, I think, are getting a little bit confused, because if you were to read the news, the Chinese GDP number was actually lower than expected. So if it's lower than expected, then why aren't the markets crashing, right? Well, sometimes investors, they buy stocks or they buy futures based on the fact that maybe they were expecting things to be a lot worse. So maybe instead of a 6.7 GDP number, when they were expecting 6.3. So when the 6.5 number came out, that actually seemed like positive news. So the markets bounced in Asia. United States market tried to stage a bounce, but failed by the end of the day. And so the S&P 500 index looks like it did finish in the red, not crashing, but pointing to an indication when it actually had a good catalyst to rally, it failed to rally. So in our eyes, this is actually a bearish thing, not a bullish thing. When we combine that information, okay, we also noticing that top stocks fail to rally. What do I mean by that? Let's take a closer look at the Amazon intraday chart on October 19th. Well, as you probably, if you were paying attention closely, Amazon rallied to the extent of $30+ in the morning session between about 9:30 when the markets opened to about 10:30. After that, which coincides with the same time that S&P 500 index failed to break above 2,800, so did Amazon fail to maintain a level above 1,800. Now, as you probably know, Amazon recently has traded above $2,000. So the main question that comes to mind, why are the investors not buying the dip? Because historically speaking, anytime Amazon has dropped to the extent of $200 to $300 from the top, we're seeing a ton of investors just lining up just to get a piece of action. In other words, they're lining up to buy the dip in quality names like Amazon in the expectation of the prices bouncing shortly. But clearly, with good catalysts out of Asia, we are not even having the best stocks rally. So to me, that is another bearish sign and an indication that things are about to get much, much worse. So here's some of the things that we were pointing out in the prior video, and I just wanted to review this and make one very interesting point. I'm not going to talk about a ton of details in the chart, but I just wanted to bring this to your attention, this formation right here. And so if you're a trader for a while, you know that this is generally called as def cross, when the 50-day moving line crosses the 200-day moving average line. Generally speaking, in most of the instances, after this cross takes place, you would expect a commodity, an index, a currency to continue spiraling lower. Actually, what we're looking at is a chart of Greece. Since I've shown you a couple of charts for Germany last time, which is spiraling lower, Hong Kong, China, all of their stocks, pretty much, all of their stock charts looks pretty much identical to Greece. And notice what happens after this def cross takes place. Look, the chart just continues to deteriorate. Now I'm going to take you through a few charts to point out what is about to happen here in the United States. So just keep in mind, when you see this, that is an indication of a further drop. Just keep that in mind for now. Okay, let's move on. Here's what we've got. Asia is slowing. Do you notice the similarity here? Same thing, further drop follows. Okay, now actually when we study the chart, we combine a lot more information. Just for the purpose of this video, I'm trying to keep it nice and brief and sweet. Okay, so Asia slowing again. Okay, different type of formation, but very bearish as well. And oftentimes, it looks like it managed to bounce from a death cross here, but looks like to us it's working its way, and we're pretty much going to see Japanese stock market nosedive as well. We're seeing it go way below the 22.5. Also, it did have a chance on the good news when markets were bouncing on Friday. It had a chance to go substantially higher. Instead, as you can see, it dipped way lower, about 500 points. Yes, it did close in the positive, about 100 points higher. However, it's having a hard time even breaking above the 200-day moving average, which to us signifies weakness on what appears to be good results that were announced. Now, let's combine this with some of the information here locally. U.S. housing stocks appear to us to be at pre-2008 crisis levels. Check this out. Does this death cross look similar to what I've just shown you has been happening globally with most of the major stock indices all over the world? Well, here's the death cross. Now, this time we're not looking at Greece. We're looking at Pulte Homes, a home manufacturer here in the United States, a home builder. So very similar chart. Looks pretty much identical to Greece and Hong Kong and Turkey and all the other European nations. If you take a look at their charts, they're going to look pretty much identical to this. What does that mean? It means that the slowdown in Europe is catching up to the United States. Now, you may not see the correlation, and how does it have to do with the inflation? So I'm going to break that down a little bit further in just a moment. Let me just show you a couple more charts first. So U.S. housing stocks at pre-2008 crisis levels. This chart right here, Lennar Homes, another home builder here in the U.S. So what are we noticing here? Well, looks like from $72 to $40 in just a matter of last 10 months. What you see here, if you have not taken out chart course, this is actually a very bearish pattern known as a head and shoulder. And so keep in mind, so far I've shown you the death cross. Now this is the head and shoulder, which oftentimes, as you can see, after this shoulder is formed, what happens? Watch this drop. Now this is a pretty significant drop because it equates to about 20%. Now I know in some of these stocks you're looking at what's the big deal. It falls from 52 to 40 in a month or so. It don't look that bad. Well, when you're applying these percentages to higher price stocks, and let's say $1,000 stock, 20% would be a $200 drop. That actually is quite a bit more noticeable. It would be equivalent, to a lower price stock dropping, let's say, from $10 to $8. Doesn't look like a big deal. But in the higher price stock, and I'll show you where I'm going with that in a minute, it makes a huge difference. And so what we specialize in this channel, we specialize in trading weekly options. So when a stock moves a couple of $100 within the course of a very short amount of time frame, that actually produces insane returns when you trade weekly options, oftentimes above 500% returns, in instances even 1,000 to 2,000% returns if you know where to look for. Okay, so far home building stocks in the United States clearly showing unanimously across the board. You can literally take any housing stock and you will see either this, or you will see a death cross, or you will see a combination of the two. What's happening with the automotive stocks? Well, surprise, surprise, they look like they're heading into a pre-2008 crisis levels as well. Now notice this, Ashbury Automotive Group, one of the largest automotive groups in the country. What does this look to you like? Well, it looks to me like the death cross is just about to cross over. Now, I pointed out earlier on the examples of Greece and Hong Kong and so on, that after the death cross actually develops, things do not continue higher, but rather very steadily they continue to stay in the free fall. In other words, what we're seeing, crazy declines here in the near future continue for home building stocks, continue for automotive stocks. And to top it off, of course, banking stocks are already in free fall. Surprise, surprise, we're noticing the same chart pattern on Bank of America. The death cross was just formed right here. And we're seeing a bunch of bearish reversal candles as well. I wouldn't be surprised if in the next 6 months we saw Bank of America trading maybe right at about $20, $22. I wouldn't be surprised at all. Now, some of the financial stocks are actually being impacted in a much more severe way. Look at this, BlackRock. Okay, check this out. Now, this has already taken a 20% drop, and the chart is actually pointing to a drop further. Check this out. When the death cross took place here, the stock was trading at $510. Where's that now? It is at $401. Now, that's a $110 drop. As you can see, on some of these higher price stocks, when we're talking about a 20% drop, all of a sudden it becomes a lot more clear what's going on here. So we've got financial stocks heading much lower. Automotive stocks heading much lower. Home building stocks heading much lower. Now, if the economy is doing so great, then why are the investors selling home builders? They're selling home builders because the economy is doing so good, because the unemployment rate is so freaking low that they're so excited to just keep taking profits and they just can't wait to get out of these investments? Sounds a bit contradictory, right? So what we're really looking at is that investors' action are completely the opposite of what you would typically see in the news, right? They keep talking about buying the banking stocks. And they actually kept talking about buying the banking stocks when the interest rates were going lower. So the same analysts now who are saying the interest rates are going higher, they are also recommending buying the banking stocks. They're recommending the same strategy in two type of totally different market environments. I'm curious why. Maybe because they actually work for the banks? Something to think about. Anyways, moving on here. Question of the day. Why are institutional investors not buying this dip? If they keep saying that banking stocks are such a bargain, why aren't they buying the dip? Why are some of the best banking stocks continue to stay in the free fall? If they think some of these stocks are such a bargain, why are they not buying the dip? Why are they not buying the dip in some of the best stocks like Amazon and Google and Facebook that have been driving this market higher and higher for the last 7, 8, 10 years? Why are they not buying the dip? Well, the answer is quite simple. It's because they think the markets are heading much, much lower. So oftentimes we don't want to see what they actually say on TV. What we do want to pay attention is where actually the money is going. And I believe I've shown you the examples of multiple sectors where you should have been able to clearly observe that the money is not going into these sectors. The money is not going into these stocks, but the money is consistently flowing out of these stocks. So what is the verdict and what should you be doing right now? Well, to me, the answer is quite obvious. What you want to do is you want to short the most crowded technology stocks. Why do you want to do that? Because they're heavily owned by institutional investors. When they all run for the exits at the same time, those are the stocks, regardless of how good some of these companies are, like Amazon, for example. These stocks, when all institutional investors head for the exits at the same time, they're looking to drop substantially. For example, Amazon, $1,500. Any takers? I think maybe Amazon will find a support there. You're going to say, what? Dude, clearly you've just been looking at too many charts. Amazon, $1,500. Come on. Google, 980. Anybody? Facebook, 130s. Apple, 190s. Hold on. Whoa, you Yeah, you definitely need to take a break, Leonardo. Okay, didn't you hear just this one guy upgraded Apple, okay, to $310 price target? Well, this guy generally upgrades every technology stock for the last 10 years. So I wouldn't be paying a whole lot of attention to that dude at this point, but I would pay attention to a person that I highly respect and admire, which is David Einhorn. And David Einhorn recently liquidated every last share that he had owned in Apple. As a matter of fact, all this Chinese stuff and the weakening consumer. And just think about it. If the economy is slowing, which we can clearly see on the charts, okay, the unemployment from here can only go higher. Combine that with the highest level of student loan debt, combine that with the highest level of credit card debt, combine that with the higher upcoming unemployment rate. How many people are actually going to be able to afford a $1,500 iPhone? Maybe somebody will opt to just keep their old version of an iPhone. And that is here in the United States. Think about people in China, which is the biggest market for Apple. People don't make as much as they make here in the States in China. So how would that impact the demand for Apple? With the ever-growing competition from the domestic companies in China that basically fabricate a copy of Apple, they call it Oppo, that sells for $200. When the Chinese consumer, with the slowing economy in China, is going to be faced with the decision, buy the $1,500 Apple phone or buy the fabricated Chinese version for $200. Which decision do you think they're going to make? I don't think Apple is heading to $310. Just a simple math. If the demand is going to slow, sales are going to slow, stock is going to drop. All right, so here's the deal. Amazon, $1,570. That's what we really think. That's what the chart is showing. Nice little double top right here. Divergence on the RSI. Bearish candle formations. The list goes on. Guys, if you want to learn how to short the stocks at the top, because if you've been following our videos on this channel, we have actually showed you specifically when we shorted Amazon right here between 2000 and 2050 level, when everybody was screaming that, oh, the second company hit $1 trillion, and everybody was super bullish, super excited. We were shorting it right here. Then we were shorting it right here. So in both cases, okay, we were able to call for the top, utilizing our simple 5-step process in reading the charts, in trying to identify moves before they actually take place. Now, you probably know that Amazon is announcing earnings this Thursday in 4 days. So what is actually going to take place? Well, if we can identify the predominant behavior in the marketplace, and so far we only had one FANG stock that announced earnings, which was Netflix, and we did post a video about Netflix when it was going to the moon after the earnings report, trading around 380 plus, 386, and we did say that Netflix was going to drop initially to 350 within 24 hours and later to 330 within 72 hours. Well, I don't have the chart of Netflix here, but if you're curious, it is traded and finished Friday at a level of $332. That analysis was based on our simple 5-step formula that you can learn in our chart course. So if you're curious how to predict these moves before they actually take place, you don't have to be a rocket scientist. It is actually very simple. You can learn it all in our chart course. Just click the links below this video and take action. You will also be able to learn the top 3 chart patterns for shorting stocks. And if you're not sure what shorting stocks is, it is actually making money when stocks drop. And just think about it. How cool is this? Stocks drop a lot faster than they climb. So you're looking to make significantly more in a shorter amount of time. Basically, if you're a trader, to put it in other words, it's the trader's dream. And so these three top chart patterns are going to help you identify some of the greatest entry points before the stocks actually make moves and how you're going to be able to profit from that. Okay, Facebook 132. Hey guys, out of some information I've shown you in this video, can you see anything on this chart? Is there like one thing that you can possibly point out? Well, look at this. Death cross on Facebook. What happens after the death cross? Yes, you're going to argue, you're going to say Facebook is not going to go to 130 bucks. It's got a major level of support right here. Okay, that's where it has fallen in. You know, with all the crazy stuff going on early in the year, it fell to a low of 148. It recently just now fell to a low of 148. There's no way. There's so many institutional investors been buying the stock there. There's no way they're going to let it drop below 150. Well, I think we're going to see it much lower. And I'm not saying tomorrow, but over the course of the next couple of months, we can easily see Facebook drop significantly lower below that 150 level. Google, 980s. Really? Actually, I really like Google. It's a great company and a great stock. Unfortunately, that's not what the charts are telling us about Google right this very moment. Interestingly, if you use your imagination just a little bit, where do you think this situation right here is going? Look at the blue line and the orange line and try to think and use your imagination going a couple of months ahead from here. Well, to me it appears that maybe the blue line is getting closer and closer to the orange line, and at some point in the next 60 days, or possibly shortly after the earnings report, there's going to be a death cross formation here. Now, there's been multiple multi-top formations right here, out of which, on great news, Google has not been able to rally. And Google is also announcing earnings this Thursday. And so if we to analyze the last report, which was happening right here, and you can see it actually gapped up and went higher for a couple of days, look what happens after that. It actually sells off and goes lower. And this seems to be the predominant pattern in a lot of stocks. So at the end of this video, I'm going to actually reveal a very simple strategy how you can take trades this week and next week and utilize this simple strategy to make quite a bit of money. So here's what we think is going to take place, observing the behavior in the first FANG stock that actually reported, which was Netflix. After a great report, Netflix went higher. We have pointed out multiple reasons why the stock was actually going to drop in 72 hours, and it did. We're expecting the same projection in Google, Amazon, and Facebook when they announce earnings. In other words, initially we expect them to deliver great earnings report on which we expect them to initially move higher, only to see them sell off within the following few days. So in other words, what are we saying is short the bounce. Short the bounce in these stocks utilizing put options when these things go up. I know that sounds contradictory. If you have not watched most of our videos, I know it's got to sound contradictory. What do you mean? You want me to bet that something is going to go down when something is actually going higher? Yes, I know it doesn't sound right. It doesn't sound something that a person would do naturally, but trust me, that is exactly what you want to do when you're trying to make money when stocks fall. And if you're curious to learn more about that, click some of the links below this video and get some more information. Okay, here's the second week of earnings, which is very, very busy. There's so many companies that actually announced earnings this week. It's absolutely humanly impossible to keep track of every single stock. But generally, we try to identify maybe around 70, 80 stocks in the first few weeks of earnings, and we try to study them. And we try to identify the following few things. Now, number one, we try to identify the path of least resistance by looking at many, many charts. Number two, by looking at the charts, we try to identify the predominant pattern. And number three, we try to arrive at a strategy on how to trade these earnings. Okay, so here's what we've got. I'm not going to bore you because this video would last for hours if I tried to give you information on all of these stocks that we're actually considering trading. Okay, and there's about 70, 80 of them. So I'm just going to show you some of the conclusions. Okay, and so the predominant three chart patterns in 80+% of the companies that are reporting earnings this week are the following. As you can see from the chart of Lennox International, ticker LII, you could see the similar formation where the distance between the orange line and the blue line is narrowing, oftentimes leading, along with some of the other things on this chart, to a bearish crossover. Studying the cases of Greece, Hong Kong, and some of the other cases that I used as an example earlier in the video, we believe that after this crossover actually takes place, the stock is heading much lower. Now, this particular stock, we're just using the chart to bring up an example that represents this type of chart development in many, many charts that are actually announcing earnings. In our view, again, in combination, not just using this, but in combination with some of the other chart patterns, this leads to a further drop. The second type of pattern that we're observing, in this case, it's not really a pattern because we're talking about the bearish crossover, known as, again, as a def cross. We're observing this in multiple stocks that announcing earnings. In this case, we're taking a look at the chart of PII, Polaris Industries. So they, I think, produce some four-wheelers and things like that. So this is actually another thing that confirms our deflationary fears, because automotive sales, investors clearly think they're going lower. Housing sales are going lower, on top of increasing prices for raw materials due to tariffs. That actually puts pressures on the margins for all of these retailers, home builders. Lower sales, higher cost productions does not equate to higher stock prices. Same thing with the automotive industry, and now this is an example of actually a four-wheeler manufacturer, retailer. Things are just not looking good. And you will notice this bearish crossover again in many charts of many companies that announce earnings this week. So this is the second main similarity in many charts of the companies that are announcing earnings, which is very bearish. And again, the predominant actual chart pattern, we're using Hasbro's example here, but this head and shoulders, again, very bearish pattern, and many stocks that are reporting earnings this week, they definitely show very good resemblance with this chart pattern. So in conclusion, what do we want to say? Well, this week is going to be absolutely awesome. Here's another Bank of Marine. Not sure what that is, but I do know the chart is pointed to a move lower. As you can see on this chart, not only does it have the head and shoulders pattern, but it also has what I am convinced is going to result in a def cross in not so distant future. Okay, and oil stocks, wow. I mean, it's unbelievable. Some of the oil stocks actually have been dropping, creating massive crossovers, massive bearish crossovers, starting in August, and they continue the downward spiral. And I think that's actually going to continue considering the oil prices are breaking lower. Okay, and for those of you who are still watching this boring video on charts, okay, I did tell you I was going to reveal a simple trading strategy, okay, and here it is. As you see all these bearish charts in majority of the companies heading into earnings, it does not mean that all these companies are going to drop when they actually announce earnings. So when they do go higher, in my view, it presents a great opportunity to come in and buy puts, because overall, it's going to be a short-term bounce. Call it a dead cat bounce. Call it whatever kind of bounce you want. But you want to short these stocks on the bounce, utilizing put options. And if you'd like to get more information on how to do that, click the link below this video. Waste no time. Get some more information that's going to help you trade with more clarity and consistency. And since stocks drop a lot faster than they climb, regardless of what kind of results you have this year so far, I promise you, if you get access to this information, you can still make your 2018 the most profitable year ever. Thanks for watching. I'll catch you in the next video.